You're being sold the illusion of a complex market. But in reality, most moves are built on one very simple thing: the imbalance between buyers and sellers. While the crowd hunts for secret indicators, big players focus on one thing: where the market moved too fast. Because that's exactly where traces of inefficiency remain. The biggest mistake beginners make is entering after the impulse. But strong traders know, the best trades often appear precisely on the return into imbalance. Stay tuned. Today you'll learn how to use these zones in your trading, and why they work the same way in crypto, forex, and stocks. If you're not yet subscribed to my YouTube channel, now is the perfect time to do it. And don't forget to like this video. For the growth of the channel, it really matters. We regularly release useful content that helps you better understand the market and apply knowledge and practice right away. And if you want to see how these concepts work in real trading, join my Telegram channel. The link is in the description and the QR code is right on the screen. What imbalance really is? Imbalance is an empty area between candles that appears during strong impulsive price movement. In other words, it's a section of the market where price moved through so quickly that no proper exchange occurred between buyers and sellers. Technically, it looks quite simple. Take 3 consecutive candles. In the bullish case, the high of the first candle's wick doesn't reach the low of the third candle's wick. Between them remains an empty zone, which price literally rushed through. What happened at that moment? Big capital entered the market so aggressively that available liquidity wasn't enough to absorb the volume. As a result, demand instantly exceeded supply. Counter orders ran out. Price passed the level without forming equilibrium. The market simply didn't have time to conduct a proper exchange between buyers and sellers. That's why this area remains empty. So at that moment, trades were extremely few or absent altogether. Fair value didn't have time to form. Balance between market sides wasn't found. What about the bearish scenario? The logic is exactly the same, only reversed. Again, take 3 consecutive candles. If the low of the first candle's wick doesn't reach the high of the third candle's wick, an empty window forms above. What does this mean? On this section of the chart, a gap appears. Price literally drops through the level, barely stopping. Why does this happen? The reason is simple. Supply begins to significantly outweigh demand. Imagine a regular store where suddenly everyone decides to get rid of their goods at the same time. Sellers become too many, buyers aren't enough, and prices start to fall quickly. The market works the same way. Large participants start selling aggressively. Buyer liquidity isn't sufficient. Price sharply moves down. As a result, the market skips the stage of forming fair value in that area. What really happened at that moment? A powerful wave of selling hit the market. Buyers were too few to hold price at those levels. As a result, no proper exchange occurred between the two sides. Price simply dropped through the range. That's why this zone remains empty. Just like with bullish imbalance, the market tends to correct such inefficiencies. Over time, price often returns to this area to fill the gap. That's why bearish imbalance also acts as a magnet for price. When you see such an empty area above current price, it's a potential zone the market may revisit later. This is exactly where many traders start looking for short entries. Where do these gaps come from? The main reason imbalances appear is the activity of large market participants. When funds, market makers, or banks enter with massive volumes, liquidity often isn't enough to instantly absorb the entire flow of orders. What happens next? A strong impulse emerges. A mismatch between supply and demand forms. The market remembers this area and later tends to return to it. That's why imbalances so often act like magnets for price. Now is the perfect time to mention our Telegram channel. If you're just starting to explore the crypto market, it's important not only to know where price is moving, but why. It's crucial to see what experienced traders and investors pay attention to instead of making decisions under the influence of noise, news, or crowd emotions. On my channel, I regularly share my own view of the market and expectations for its future development. I explain the impact of major macroeconomic events, break down the state of the global economy in simple words, and openly show both my short-term trades and long-term investments. Join in and study crypto with a cool head and a systematic approach. My goal is to help you avoid the mistakes that most beginners lose money on. The link to the channel is in the description under this video. Now let's return to terminology. FVG, fair value gap, is a type of imbalance. Essentially, it's a price gap that appears when the market moves so fast it literally skips certain levels without proper trading. Later, price often returns to this area to compensate for the imbalance. Put simply, it's the empty zone between candles which the market frequently revisits after some time. Bullish FVG, a gap formed during upward movement. When price returns to this zone, traders see it as a potential buying area, expecting continuation of the rally. Bearish FVG, a gap formed during downward movement. When price returns to this zone, traders look for selling opportunities, anticipating further decline. Sometimes instead of the term FVG, you'll hear price inefficiency. In essence, it's the same phenomenon, only the wording changes. The opposite is efficient pricing, when price develops smoothly without sharp jumps or gaps. How a trader uses imbalances. From a practical perspective, imbalance serves 2 important functions. Attracts price. The market tends to return to areas of inefficiency to close the imbalance left behind. Such zones act like magnets, pulling price back again and again. Creates reaction. When price reaches this area, a strong impulse often follows in the direction of the main trend. This is because the market restores balance and continues moving in the dominant direction. For us, this is an area of interest, a place where the market may stop, reverse, or accelerate. That's why such zones are considered potential entry points for trades. Working with timeframes. Higher plus lower combination. Any analysis begins with a higher time frame. Higher time frame shows intentions of big capital, key zones of interest, overall market direction. Lower time frame is used for defining entry zone boundaries, finding confirmation signals, validating the chosen scenario. This is one of the fundamental rules of analysis. First, the higher time frame, then the lower. Only after that do we look for the entry point. Premium and discount. How to choose the priority zone. To determine which imbalance has greater priority, traders use the Fibonacci grid. In an uptrend, it's drawn from the local low to the high. In a downtrend, from the local high to the low. The 50% level is considered the balance zone, or fair value. Everything above this level belongs to the premium zone, the area where the asset is relatively expensive, and selling makes more sense. Everything below belongs to the discount zone, the area where the asset is relatively cheap, and buying makes more sense. Buying at a premium or selling at a discount means working against market logic. What does this usually lead to? Lower percentage of successful trades, less favorable risk-to-reward ratio. Liquidity, the fuel for market movement. To understand price behavior, you need to grasp one simple principle. Price always moves from one liquidity pool to another. Liquidity is the fuel behind every market move. External liquidity, stop losses and orders placed beyond local highs and lows. Internal liquidity, orders located inside the current range. If you observe the market, you'll often see the same scenario repeat. The classic cycle looks like this. Market collects external liquidity, then makes a correction, returns to fill imbalances, and continues the main move. This process repeats again and again. Now let's build a simple analysis algorithm. Just 3 steps. Step 1. Define the trend and direction on the higher time frame. Step 2. Mark the key liquidity zones. Step 3. Find current imbalances that may become points of interest. Even these 3 steps are enough to form a working scenario with high probability of success. Entry on the lower time frame. After that, we switch to the lower time frame. We have 3 tasks. Refine the boundaries of the entry zone. Get confirmation of the scenario. Identify the exact entry point. What can serve as confirmation? Liquidity sweep. Break of structure, BOS, formation of a new imbalance. And here's an important nuance. Even if structure hasn't yet broken, the very fact of price returning to an imbalance zone can already be treated as an early signal worth attention. If you want to dive deeper into these concepts and learn how to spot them in the live market, you already know where the link to my Telegram channel is. Mathematics and risk management. Now let's talk about what separates a trader from a gambler. Mathematics. If you work with a risk-to-reward ratio of 1 to 3, then to stay profitable, you only need to win about 33% of your trades. Think about that. You don't need to guess every market move. You don't need an 80% or 90% win rate. Even if 7 out of 10 trades are losing, you can still remain profitable over the long run. This is the power of a systematic approach. Professional trading is built not on guessing, but on proper risk management and maintaining a statistical edge. Let's sum it up. Imbalance is not a complicated theory, and certainly not a magical tool. It's simply a section of the market where buyers or sellers entered so aggressively that price didn't have time to form naturally. When you understand market context, work correctly with higher and lower time frames, account for liquidity zones, the market stops looking like a chaotic set of random moves. It becomes much clearer, structured, and logical. But theory alone means nothing. Real skill comes only through practice. Work with historical charts, run backtests, scroll the market backwards, practice scenarios on a simulator. This kind of practice quickly builds experience, strengthens confidence, and helps you spot repeating patterns. The more quality practice you get now, the fewer costly mistakes you'll make in real trading. If this video was useful, make sure to like it, subscribe to the channel, and check the description. There you'll find all the necessary links, extra materials, and practical tools to help you continue learning and deepen your understanding of the market. Thank you for watching. See you on the market.